Well, we are at 8 o'clock, so I'm going to start kicking things off with a few housekeeping items as everybody kind of gets settled for today. Thank you again for joining us this morning. Hopefully everybody's a little bit more well rested than yesterday morning. Again, thank you for joining us. We are going to be covering some current topics today, but again, those few housekeeping items for you this morning. One, as you get acclimated with the platform here, I would like to encourage anybody attending to submit questions via the control panel. If you found that in that chat feature, we will address those as we can throughout the presentation, but certainly if your question cannot be addressed, our team will be following up with you. I do want to point out that we will be launching polling questions throughout the webinar. And please complete those, especially if you are looking for continuing professional education for attending the seminar. There will be 3 throughout the presentation. And at the conclusion of the webinar, there will also be a short survey that will launch, which will need to be completed again for that continuing professional education. Certificates for the CPE will be emailed to you within 2 to 3 weeks after the program. So please be mindful of that for your continuing professional education. Another item would be also, if you're just checking out the control panel, you will see the handout section of the control panel where you can download the slides for today's presentation. So feel free to do that. And note that we put, again, quite a bit of information in there, some information you may have seen before towards the end, but we just wanted you to have resources, and we won't necessarily be covering every slide in detail today, but wanted you to have some additional resources to take with you today. The webinar will be recorded and will be sent out for on-demand access after this session, so please watch for that. And then as we get things going, just wanted to note that obviously in the current state of things, there are still some unknowns as it relates to election results and what the future might hold here. So just keep that in mind. Our goal today is really to just provide some analysis based on what we do know now and what could happen down the line from the tax perspective as election results continue to play out. Okay, so again, thank you for joining us. With that, we're going to jump right into our materials for today. First, just so you're familiar with us in front of you today, I know many of you are a little bit more familiar with my colleague Jim Brandenburg, typically doing some of these updates, so I will be stepping in for Jim today. My name is Jenny Kramer. I am a tax partner here in our Milwaukee office. And joining me is likely a little more familiar face. I'm going to hand things over to Glenn Birnbaum now.
All right, thanks, Jenny. Yeah, I'm Glenn Birnbaum, and I'm a tax partner with Sikich here in the Peoria office. So today we're going to try to do a little post-election recap. As Jenny said, there still are several things in flux. So we'll see how the next days and weeks and possibly months pan out here. Okay, so just a quick this is our kind of main overview slide here. So I'm going to start talking about, kind of what we know about the election results, get into a little bit about maybe some committee changes in that in Congress. Then both Jen and I are going to talk about, okay, what might this mean for 2023 when we see the new Congress? How might that be different than the 21-22 Congress? Jenny's then going to talk about kind of an IRS leadership and enforcement, some new things going on there. Then she's going to get into what we might call the lame duck session of Congress and what legislation might pass here between now and the end of the year. This kind of ties in with certain tax provisions have already expired or will expire in 22 and 23. And then I'm going to just briefly touch on, because every year we get closer to this point of the Tax Cuts and Jobs Act. There are a number of provisions that expire in 2026. I believe the number is 23 provisions. So we'll talk about that as we look forward. All right, so that's the overview. Okay, so let's start with our baseline here. What is the current makeup of Congress? Where do we sit, before the election? So in the House, remember we need, there's 218 seats needed to control the House. So the Democrats had 220, Republicans at 212, and there was actually 3 open seats, okay? And in the Senate, 50-50, with the vice president able to break the tie on the Democrat side. So that's kind of where we stand currently. Now, what about the election results? Again, as Jay said, this is all to be determined. We are using the Associated Press. I just looked this morning and kind of updated this slide as best I could. So these are races that have been called by the Associated Press. So in the House, 184 on the Democratic side and 207 on the Republican side. So with 44 seats still that have not been called. So again, remember that 218 number. So neither party at that number yet, okay? On the Senate side, Republicans 49 and 48 for the Democrats, okay, with 3 seats to be determined, okay? So as you can see, nothing really has been finalized yet. So let's talk though on this next slide about these 3 Senate seats to be determined, okay? So we have Georgia, we have Nevada, we have Arizona. Those are the 3 seats. Georgia, basically neither candidate got to 50% plus 1 vote. So there will be a runoff, another election on December 6th, okay? About a month away, a little less than a month away. So then we have Nevada and Arizona, and the percentages that we show there, that's the estimated vote that's in right now. So Nevada is 81%, Arizona is 70%. So, and in this case, right now the Republican candidate is leading in Nevada, and the Democratic candidate is leading in Arizona. So what does all this mean? Well, basically, whichever party wins 2 of these 3 Senate seats will have control of the Senate. So if you go back, Republicans have 49 right now, so if they pick up 2 seats, they'll be at 51. Democrats are at 48. If they pick up 2 seats, they'll be at 50, and that's all they need. So that's really the key thing is, how does Nevada and Arizona go? So it is possible if Nevada and Arizona go to, one party or another, both seats, then the Georgia election would actually not matter. Okay. All right, Jenny, you think I'm missing anything so far? I mean, this is, again, we're not prognosticators. I guess I will. It does seem like the House may slightly go to the Republicans by a few seats, but at this point, that has not been called yet. So.
Right. No, I think you've got it covered here with what we know at this time, and the Senate's going to be interesting to see how that plays out. It's going to take some time, but as we kind of allude to, I think we're still going to be moving forward tax-wise and legislatively. So that's some of the stuff we want to get into. And I think, Glenn, if you want to highlight some of the key players and really start getting into, what do these election results end up meaning in the tax world of Congress?
Sounds good, yeah. So just a quick recap here of, current Senate and House leadership. Nancy Pelosi being the Speaker of the House Minority Leader being Kevin McCarthy, and the Senate, Chuck Schumer and Mitch McConnell. So that's, again, existing leadership, but, hey, this is a tax webinar. Let's talk about the tax writing committees. Okay, so we have the Ways and Means Committee chaired by Richard Neal, and then the ranking member on the Republican side is Kevin Brady. And then on the Senate side, we have Ron Wyden and Mike Crapo. So again, that's our existing tax writing people. So if, again, we don't know for sure, but if the House would turn Republican, this is just, again, potential kind of scenario planning here. What would happen to leadership? Kevin McCarthy would be the House Speaker, with then, Nancy Pelosi being Minority Leader. Right now, many people believe the Senate probably would stay the same. So at this point, we have Chuck Schumer and Mitch McConnell still in their seats. But what about it when we turn to the Ways and Means Committee? Here it's interesting because Kevin Brady, he basically is closing out his term here, end of the year. So there would be a new Ways and Means Committee chairman, again, if the Republicans would have control of the House. And there's, a few people vying for that. Maybe 2 or 3 Republicans that could line up for that. And obviously on the Ways and Means, I believe it's maybe 25 on the 25 Democrats, 18 Republicans, something like that. So, those numbers would change and there'd be more Republicans that would get seated. So just something to keep in mind, that there would be some new leadership changes, particularly on the Ways and Means Committee, if the Republicans take control of the House.
Right, changes throughout that committee, and these are, where it all starts in this committee. That's who the writers are and the ones who really put forth these bills. So it is of significance.
Yep, and, the Ways and Means is, to all, I believe all tax bills must start in the Ways and Means Committee. So that's where it starts. Good. I think we're
Perfect.
ready for question
Yep.
one.
We have our first polling question. So everybody take note, continuing education, take a look at your polling question, please participate. Easy question here, no right or wrong answer. Based on the election results thus far, what do you expect will happen to tax rates in 2023? Do you think they will potentially increase, decrease, or stay the same? So based on the election results thus far, what do you expect will happen to tax rates in 2023? All right, giving everybody just a moment to answer. All right, we do have some thoughts here that we might see increases, or the majority saying it would stay the same, with the minority looking at a potential decrease. Okay, thanks for your thoughts on that.
Okay. All right, so yeah, full question one down, just two more to go to get your CPE credits. So, all right. Okay, so based on, kind of what we know about the election, we kind of want to use this next part to talk through what some impacts might be in 2023 for Congress. So, first thing, and I want Jenny to jump in here, and hopefully we can have a bit of a conversation here, is, this reconciliation process that was used in 2021 and 2022. This is a way to, be able to pass legislation without getting the 60 votes needed in the Senate. It would seem likely that it's not going to be used, again, if the Republicans have it.
So why, Glenn, why wouldn't the Republicans be able to use the reconciliation process? That was really how bills were passed in the last year.
Yep, good question. So to be technical, Republicans could use it. The question is, why would they use it? Because ultimately, President Biden can still veto everything. So it'd be a lot of effort, a lot of work, it would seem like, for no real payoff. Why not just try to get, 60 votes in the Senate?
Right, because if you can get the support of Biden, you think you can get the support of those extra Democrats. I mean, you do hear, talk in regards to, is it worth it to at least put the bill forward, knowing it might be vetoed, just for purposes of messaging, making him, in front of the American public, actually veto something. So do you think that could play out, or is this really not a lot of motivation to go down this route?
Yeah, I mean, you do hear that. It would seem like a lot of work just for a messaging bill, but, I guess, it remains to be seen. But I think the big picture takeaway here is it would be a different landscape, right? And so, needing that 60 votes in the Senate would certainly change the nature of these bills and what would be put in them. So,
Right.
So
We did have a question about whether the Democrats would be able to do, or why wouldn't they pursue a reconciliation bill during the lame duck session. I believe, if I'm correct there, Glenn, you can only do, one per year. I think they've used their opportunities for reconciliation at this point.
Yeah, that would be my understanding as well, Jenny. So, yep.
I just don't think there's an opportunity. So yeah, as we move forward, I think you will see the fact that, we're going to need bipartisan support on things going forward here.
Yeah. And again, maybe the House is only, 2 or 3 seats in the Republican favor, maybe 1 seat. It could be very razor thin here. So it's going to be an interesting 23 for sure. Okay, so just again, it's some other kind of big picture bullet points here. It would seem like most people think, there's going to be little appetite for new taxes. Again, assuming Republicans have the House, obviously, if the Democrats are able to maintain the House and they have the Senate, certainly things could come back. Build back better, those type of things. We'll have some slides on that in a bit here. I think ultimately, yeah, the administration is, and Congress both are going to, need to work together to be able to really get something, bill passed into law here in the next couple of years. Let's see here. So some more commentary. Um, yeah, I think I've talked about this. Right now, I think the best guess would be Republicans would take control of the House, but every day it seems like it's a thinner and thinner margins. So can't even really say that for sure. We did talk about the Georgia runoff on December 6th. Do remember there were two major tax bills passed, the American Rescue Act and the Inflation Reduction Act. And there may be certain technical corrections that are needed. Again, we're talking about, 2023, 2024, certain technical corrections that might be needed. So we'll see how that plays out. But there is some fairly recent legislation. The Inflation Reduction Act was passed in August, so there is going to be some potential cleanup to do there if there are certain corrections needed. Okay. So we did briefly touch on the Build Back Better. There were a number of provisions that never did get passed. I'll have a slide on it just in a few minutes here. Inflation Reduction Act, Jenny's going to talk about this fairly shortly, is, this 80,000 or more IRS agents and increased enforcement. And so, Republicans, if they would have the House again, they're going to try to seek to scale this back, right? Maybe some way, put some guardrails on this enforcement. Just thinking ahead here, Tax Cuts and Jobs Act, a number of things changed in 2026. So, will Republicans try to, attempt to make some of these things permanent? Very likely they would try to do that. Democrats are thinking about things like the enhanced child tax credit, things of that nature. And Jenny's going to talk about that a little bit. So
yeah, Glenn, it does seem like there's motivation to accomplish some tax agenda items here, whether it be before the end of the year in 2023. And if we have a split, a division between Congress and the administration, Biden ultimately has to sign on any of these things. Do we really think anything's going to get passed? How do we accomplish any of this going forward?
Yeah, it's going to be interesting. Again, with these range within margins, it seems like a lot of things will just kind of be status quo for these next couple of years. So we'll see.
Or there's going to have to be some compromises, right? So a little bit of give and take. We have agenda items here for both Republicans and Democrats, and we might have to see some things being accomplished on both sides of the aisle if they're going to reach an agreement.
Yeah, I mean, we're very used to one vote mattered in the Senate, right? Depending on whichever senator it might be, that can matter. I mean, we could be in a situation where one vote really does matter in the House too, so that could be pretty interesting.
True.
Okay, something else, Secure Act 2.0, kind of a retirement provision that's going to be potentially in the works. Jay's going to talk a little bit about that. We just really don't expect major changes on the tax side. That's kind of the big picture. We've already touched on technical corrections and Jenny, compromise. Yeah, parties probably going to need to compromise on anything to actually get something put into place. So
agreed.
So let's see. Jim Brandberg, and he wasn't able to be with us today, but yeah, he put this slide together. I think it's a nice little summary of what the Ways and Means Committee had kind of originally proposed. If you remember, there were things to deal with basis step up and higher capital gains rates and things for certain taxpayers. And as the Build Back Better, and then ultimately the Senate, the Inflation Reduction Act, most all those things got carved away. So again, if the Democrats would be able to maintain the House and the Senate, would some of these things be back in play? Just something to keep in mind is what was proposed versus what ultimately ended up in that Inflation Reduction Act bill.
Sure, no, that's helpful, Glenn. Thank you. Well,
All right.
I'm
So
going to then, I'm going to touch on just a little bit of sidebar, a little bit of interesting time here in regards to where IRS leadership is at, and touch a little bit more on this enhanced enforcement that we're talking a lot on from the Inflation Reduction Act. So I just want to lead into that. It's just an interesting layer as we also go through these election times. So, first, leading out of the Inflation Reduction Act, one of the more controversial items in there is this IRS enhanced enforcement. We've hear about it in the news. We talk about this item quite a bit. So this is an item we're going to keep hearing about. This is that $80 billion of funds that has been appropriated to the IRS to focus on 4 key areas. $4 billion of funds to enhance taxpayer services. And then the biggest item, $45 billion and most controversial, for enhanced enforcement activities. What does that mean? $25 billion for operation support within the agency and $6 billion towards technology modernization and improvements. So we saw this set forth in the Inflation Reduction Act. I think we're going to, this is a crucial time where they are laying the groundwork for the next 10 years of spending this $80 billion of funds. I think based on what we've dealt with recently with the IRS, you're going to expect to see an earlier impact of these funds focused on that service angle and security. There's a lot of controversy surrounding security measures, and the IRS is going to need to address these, at the forefront of their plans. And also keep in mind, I know, that we're going to talk more on it, this $45 billion towards enhanced enforcement activities. There needs to be a lot more definition and clarity as to what this is. There is, this is the item being attacked in the news in regards to what are these extra 87,000 agents going to be doing, and how are they going to be impacting the lives of our taxpayers and businesses. Do keep in mind that there's a lot of good that can come from some of this. They're allocating funds towards taxpayer services is really important right now. Whether taxpayers realize that, and certainly us practitioners know that, we are sitting as of October 28th with $4.4 million tax returns remaining unprocessed with the IRS, from tax year 2021 and late filed other prior tax returns. So this backlog has been on, IRS's agenda for a couple of years now as we've come through the pandemic, and Congress has really been looking to the IRS for answers on behalf of taxpayers as to how we can make progress on this and get better services to our taxpayers. Also keep in mind that when we talk about 87,000 additional agents, the IRS is expected to have roughly 52,000 of their current 83,000 employees and personnel eligible for retirement over the next 6 years. We have 8,000 agents either retiring or changing professions each year. So, this is all to be determined. A plan needs to be worked through as to how this is going to be deployed. But there is definitely some needs within the IRS where I think we can see some good done from some of this. Now, layered into this timing of this enhanced enforcement at $80 billion coming into the IRS is the fact that we are also sitting in a time period of a change in leadership, a change in the commissioner at the IRS. So we currently have Commissioner Rettig's appointment expiring here on November 12th in a couple days. We have seen, they have appointed an interim leader here, Douglas O'Donnell, as interim acting head of the IRS for this time period. These things don't happen quickly. So the hard part is we haven't seen the Biden administration yet nominate. I think they're going through the vetting process, which, they need to do that process first to make sure they're comfortable with who they're going to put forward and nominate, because next, after that nomination is made by the Biden administration, Congress then has to go through their vetting process and approve this nominee. So it is not uncommon for this to take quite some time. For example, I believe Commissioner Rettig's time period from nomination to appointment was 7 months. So the interesting part here is we are at a critical time period of the Inflation Reduction Act being passed, $80 billion of funds being appropriated, and we have a directive that the IRS does need to provide an operational plan for that $80 billion within 6 months of enactment. So we're looking at a release of that plan for mid-February. So this interim acting head, Douglas O'Donnell, is actually going to be very integral to that plan. And fortunately or unfortunately for him, that plan needs to keep moving forward. And there's going to be a lot of scrutiny in regards to making sure that there is clear definition in regards to what that enhanced enforcement means. Douglas O'Donnell is a 36-year veteran of the IRS. He served in many roles and knows the agency very well. He was commissioner of the Large Business and International Division for 6 years, so he certainly is very familiar with the IRS and the struggles that it has and how it might use these $80 billion of funds appropriately. It is unique and unfortunate, though, that I think O'Donnell is going to be prime to developing and devising this plan, and then we'll be handing it over to this appointee when they're approved to really have to carry out that plan. So it's just a really interesting time to have all these dollars flooding into the IRS, a huge plan to be developed for 10 years of spending, and the core leadership, the person at the helm to do that, is in the midst of a changeover period right now. So that's going to be something to watch. And again, keep in mind that mid-February is targeted for when the IRS is supposed to have that operational plan released. And I think it's going to be, several months before we have an approved appointee for a true commissioner who will serve the next 5-year term. They serve 5-year terms. So with that, like I said, we have certainly that commissioner is going to be looked at in regards to what is this enhanced enforcement going to say? They're going to have to answer questions during their vetting process with Congress in regards to their viewpoints on that and very clear directives on that. And we have seen a lot of scrutiny by Republicans who are highly motivated to work on repealing, some of this part of the act. As we've talked about with Glenn, it remains to be seen, even if they have control of the House and or the Senate, whether I think President Biden, this is something that was in the crux of, he doesn't want to change anything, that Inflation Reduction Act. So it would have to be quite a bit of a compromise to, pull that out in any way. So I think, the interim commissioner and the commissioner to come is certainly going to have to move forward as if they have these funds, and they need to develop that plan and set that plan moving forward. But keeping in mind the dissatisfaction on both sides of the aisle with the IRS currently. We have both Republicans dissatisfied with the fact that there is this intent for expanded audits, and who is that going to cover, and how is that going to be disrupting taxpayers and businesses' lives. And then we have, over the last year or two, certainly any new commissioner is still going to have to answer to. Congress has been very pointed and wants more reporting and information in regards to how was there a significant leak of high net worth individuals' tax returns, unprecedented before. So there are security issues that are a top concern for any new IRS commissioner. On the Democratic side of the fence, we certainly have questions and scrutiny in regards to Reddick's previous refusal to release Trump's tax return. And there were some controversial audits of former top FBI officials that seemed, statistically suspicious. But on both sides of the aisle, we also have accountability from the standpoint of, we understand that there were 30 million unprocessed paper filed tax returns that were just destroyed in 2021. So just kind of laying the groundwork on the controversy that has built here with the IRS and what a new commissioner is facing. So I'm sure you're all now rushing to put in your application for nomination for this very prestigious role that, only comes with being able to testify in front of Congress numerous times throughout the year and try to appropriate $80 billion in funds over the next 10 years. So it's just a really, really interesting time and a really interesting layer, I think, that plays in as we also move through the election, that I wanted to highlight and give some people some additional information on.
Very good, thank you. All right, I think it's time for poll question number 2.
Okay, perfect. You'll see that come up on your screen now. So looking at this question, again, just pay attention to answering this question if you're looking for continuing education, we want to look at what do you expect to happen to the number of IRS audits in 2023 as a result of the Inflation Reduction Act. Would you expect them to increase, decrease, or no change? So again, polling question at this time, what do you expect to happen to the number of IRS audits in 2023 as a result of the Inflation Reduction Act? Do you expect them to increase, decrease, or no change? Okay, thank you, everybody. So we have a little more certainly leaning towards the fact that we might see an increase in audits in 2023 as a result, and potentially a little bit on the no change side. But I don't think anybody can see them decreasing. We are at pretty low audit rates at this point in time, but what remains to be seen what will really be the crux of this enhanced enforcement that was a result of the Inflation Reduction Act. Okay, thank you. Moving forward, okay, I want to jump into now a little bit of this lame duck session, right? What will we possibly see before year end, and how could that be done? As Glenn led into the fact that kind of no matter where these election results end, we're going to have to see some compromise probably, but there is some motivation to clean up some things before the end of the year. So how could that happen? So again, just following the political process a little bit, how could things get done during the lame duck session? It's certainly going to be a busy time. There are bills that are required or have to be passed, so to speak. We do have what's known as a continuing resolution bill. That's when we have Congress and the President have not yet approved final appropriations. That fiscal year ended as of October. And so we had a continuing resolution at that time. That is what keeps the government funded, keeps things running, so we don't have a government shutdown during this influx period where Congress and President haven't yet approved the appropriations. 1 second here while I change my...
Yeah, it's just had a little headphone issue. Yeah. There's the things that she said that need to get done. So
there, thank you. All right. So continuing on, we are looking at the lame duck session needing to address the continuing resolution bill as government spending is set to expire December 16th. And that is something easily that some tax extender items or some of these tax items we're going to talk on can be attached to if there's compromise. We also have a National Defense Authorization Act bill that would need to be passed before the end of the year. That's really annually a budget item for funding the Department of Defense. So we're going to talk through some of those extender items that could be very key in compromise this year, as well as that Secure 2.0 retirement bill. And, this is something being talked about across the country. You'll see, these items were echoed in an article just released last night by Tax Notes from CPAs and those in leadership in regards to tax writing, that these are the items to be addressed in that lame duck session. That can start as early as November 14th, regardless of what the election results are and where we are with Georgia. We're going to have to see them moving forward, finishing out this congressional year with funding the government, doing that Department of Defense, addressing the retirement bill that has been on the table for over a year. And we might see some other funding, some other, I hate to call it stimulus, but, there could still be support for funding measures for COVID-19, Ukraine, and the Florida disasters. So I think this Georgia runoff is going to have little impact on this lame duck session and moving some of these items forward. So just setting the table for the key tax provisions that do, are motivated to be addressed at this time. And they're calling these the big four, just to kind of boil it down to what are Republicans and Democrats motivated to potentially compromise on. And you're going to see those listed there. You're going to see that one individual tax provision in regards to expanding the child tax credit again. We saw that expanded for 2021 as part of COVID relief. It went away for 2022, and Democrats are highly motivated to get that at some level back to what they did for 2021. And I think that's going to be the key. There has to be compromise here. And so while maybe we won't get it back to the level it was in 2021, where can we get it increased from where it sits right now is where the Democrats are going to be motivated. Then we have 3 really key business items that are expiring here in 2022 or 2023 on the business side that there's a lot of motivation to get something done. I'm going to touch on those in a little bit here in a little bit more detail. We've talked on them in the past. It's, the R&D expenditure capitalization issue, potential interest expense limitations, and at the end of 22 here, we're going to start seeing that bonus depreciation tapering back, no longer being at 100% deduction in year 1. And so we see commentary in regards to those individuals, again, on the tax writing committees talking across the aisles and already setting the table for what can we attach to these remaining bills that have to go through at the end of the year. So again, Kevin Brady, ranking member in the Ways and Means Committee, has said, they see no problem whatsoever with attaching Secure 2.0 to one of these bills moving, and that they've been having conversations across the aisle with Chairman Neal about how to balance out these big 4 provisions that we see needing to be addressed. So this lame duck session technically can go all the way to January 2nd when this new Congress is sworn in, and we might see it go all that way as they work through these matters. But there is motivation to do so. And get these items passed before we see a lot more shuffling again on that Ways and Means Committee, like we said, when the new Congress takes effect January 2nd.
Yeah, I didn't like that January 2nd, you'd think it'd be done by December 31st, but this tax notes article, just published today, talked about, hey, maybe it gets pushed all the way to January 2nd before we actually know what the rules are for 22. So.
Unfortunately, yes, it has been in the past. A lot of these changes can be made retroactively, and as I'll explain, we will need some retroactive changes to get where some of us want this to be. So we'll continue to watch that play out. So just to give a little more context in regards to what these key items are, I'm going to touch next on a few items just to bring top of your mind, because you're going to be hearing about it over the next 2 months. Secure 2.0, we've covered this in the past, so this is an area we certainly have a lot more slides in here than what you need. So I'm going to just touch on a few key items. Keeping in mind that Secure 2.0 is a retirement-focused bill. It's piggybacks off of Secure 1.0 that passed back in 2019, and it's making significant changes to pertinent retirement bill provisions. It was passed by the House back in March of 2022, so it's already gone through the House Ways and Means Committee writing process, passed by the House, was with the Senate. The Senate has made some updates to that, and it's just a matter of it just hasn't gotten put to vote at the Senate. It has bipartisan support and backing. So I'm going to skip ahead probably 10 slides or so, and really, because the first slides really talk on where the House left off and what they did. I'm going to start off on just a few key provisions here to keep top of mind of where the Senate bill stands right now, because that's what would be next to be kind of fine-tuned. A lot of groundwork has been done on this bill, and I know we only have a short amount of time, so I don't see additional significant provisions going into this bill. It's more cleaning things up a little bit and taking off of where the Senate left off. So I'm going to bring these things top of mind as to where the Senate version has recently ended up. And you're going to see that starting with, Glenn, if you want to go to the next slide, few items here that you're going to see the main theme in regards to making things easier, reducing penalties, and making easier to contribute funds or use funds is going to be a theme. So you'll see here, there has always been at this time for individuals at lower income levels, the ability to obtain an income tax credit if they do contribute to their retirement account. And this provision allows for a little bit of change in that. This provision would change that where it's not an income tax credit where it's coming back to you in the form of cash to use for whatever you want. It actually would change this to a government matching contribution into the retirement account. So again, still incentivizing lower income individuals to contribute to retirement accounts, but making that incentive also go into their retirement account. Then you're also going to see a lot of provisions to allow, like I said, easier access to the funds in emergency situations. So this provision would allow for a limited $1,000 distribution annually that could be taken out for, very loosely defined emergency expenses during the year, unforeseeable immediate financial needs relating to personal or family emergencies. Note that there's also a provision for penalty-free withdrawals from a retirement plan for individuals in the case of domestic abuse that results in the lesser of either $10,000 you could take out in a year or 50% of the balance of the account. So again, you'll see just easier ability to pull funds out during emergencies. The next slide just talks on a change to make it easier to fund the account, right? So a little bit broader terms on that catch-up contribution, a little bit of supercharge here. When you're 60 to 63, you could add in an additional $10,000 each of those years into your account. The next slide would be the fact that it would be scheduled to increase that minimum distribution age. Right now that's sitting at 72, and that would effectively go up to age 75 under this bill. That would take some time, before it would be effective in 2031. And we would also see, again, reduction in penalties. Right now there's a pretty steep penalty in regards to, making a footfall in regards to accumulating or contributing too much, which is a 50% excise tax on that, and they'd like to see that reduced to 25% and taking away that 10% penalty if you're actually correcting it. So making it easier to correct errors. And this is a complicated area of the tax law, and they're just trying to make things a little bit user-friendly is what this bill is doing. Another provision is just the ability to use $2,500 of those funds annually to pay for high quality long-term care insurance coverage. And finally, the last one is, again, another emergency provision that's going to permit you to use up to $22,000 if you have been impacted by federal disaster. So just wanted to make sure, though a few of those items were top of mind, as you know, that is going to be talked about much more significantly over the next 2 months. That's one provision that I think there's a strong bipartisan support to have attached to any of these bills to come in the next 2 months, and we'll see that come through. All right, I think we have one more polling question here. So polling question, and then remember again, a survey at the end that you'll need to take for the continuing education. So which of these year-end items to be discussed in the lame duck sessions are you most interested in? And I'm going to touch on a couple of these provisions next. Would be the delay in the research expenditure deduction provision, changes to the interest limitation, and the Secure 2.0 retirement legislation. So which of these year-end items are you most interested in that we are going to see talked about during the lame duck session? Delaying the research expenditure capitalization provision, changes to the interest limitation, and Secure 2.0 retirement legislation. Thank you for sharing your thoughts on that. Let's see where everybody's thinking here. Okay, well, top of mind, I just talked about it. It looks like most people are interested in Secure 2.0, but let me talk on those other two here. And I think, these two do pertain a little bit more to some specialized, not every industry, but I think it does impact quite a few individuals or businesses when we look at their research expenditure, capitalization, and interest limitations. So I'm going to touch on those next. These are those provisions that are set to expire here in 22 and 23. Talk about the interest expense deduction limitation, research expenditures, and then, so these are ones that are already impacting 2022. So whatever change would be made would have to be made, theoretically, we'd want to see them made retroactively so that it's effective back to 1/1/22 and we see no impact by these. The one item that is set to come into play here for 2023 is starting to scale back that bonus depreciation from 100% down to first 80% in 2023. So let me just touch briefly on a few details of how this could impact you or your business. Again, these are the items that are really motivated to help businesses, while we have on the other side increased benefits for the child tax credit to be motivated to impact individuals. So the interest expense deduction, whether you're familiar with or not, it is applied to a few less businesses in the fact that there is an exception if your 3-year average of annual revenues is less than $27 million. That's the threshold we're at for 2022. But keep in mind that there is aggregation rules for that. So it does look at commonly controlled and entities as a group. So yes, this is an application that comes into play only for businesses that are 27 million in revenue and over, but it can be more far-reaching. There are some other intricate details that come into play if you have passive owners and losses. So
There's always exceptions.
yes, there's always an exception. So pay attention. This could come into play. You may hear your tax accountant talk about this. It's the fact that interest expense could be limited, and it's a separate calculation that's done. And the reason 22 becomes so significant is because it's based on your interest doesn't start to be limited until it exceeds 30% of your adjusted taxable income. And adjusted taxable income until 2022 was calculated as your taxable income, adding back interest expense, and then also very significantly adding back tax depreciation and amortization. So on very capital intensive businesses, you are going to see, obviously they oftentimes are going to have financing and pay interest expense to support the purchases of those capital expenditures, but we had the nice compromise that you could add back that depreciation on those assets when coming to your adjusted taxable income before applying the 30% limitation. So the problem is in 2022, that add back goes away. You are no longer able to, at this time, add back your depreciation and amortization when calculating that 30% limitation. So I'm going to walk through a really quick example here, or you have that in your slides. You can definitely see how that impacts when you move from 21 to 22 with the more stringent calculation and also the unfortunate timing of just higher interest rates that we're dealing with in this inflationary time. So for example, in this example, it's just laying out a very simplistic fact pattern where you have $1 million of taxable income before interest expense. You have $1.5 million or $2 million, call it, of depreciation and amortization, and $600,000 of interest expense back in 2021 that now equates to $900,000 of interest expense because of climbing rates here in 2022. So on the next slide, you'll see how that plays out in a very significant way, where in 2021, under the ability to add back depreciation and amortization to your adjusted taxable income before applying the 30% limitation, there was no disallowance of that $600,000 of interest expense. But here in 2022, we no longer have that add back, and our adjusted taxable income is much lower. So we are only able to deduct $300,000 of interest expense. In climbing interest rate environment time, where we had $900,000 of interest expense actually incurred during the year, we now are facing a disallowance of $600,000 of our interest expense. So I don't want to get into that too deeply, but that you can just see that in a very simplistic fact pattern of how significant that can and may be if we don't have that provision put back in where you can add back depreciation and amortization for those capital intensive businesses. The number 2 item of the big 3 business provisions here for the lame duck session is research and development expenditure capitalization. I know we've talked about this on our webinars before. I know it's something that as the years progressed, we've just talked on more because we were just shocked that we didn't see a provision come through to correct this or to scale it back from where it was. Again, these were provisionals, pay-fors put in the original Tax Cuts and Jobs Act that they needed to do to get that to balance. And so, but we're looking at how, certainly in this current time, we want to be incentivizing research, and this is a provision that certainly puts a damper on that. So what this does is takes your research expenditures, which normally are deductible 100% in the year incurred, and requires you to amortize those over 5 years. Using a mid-month convention, which means in that first year, here in 2022, when this law first applies, you would only be allowed 10% of your research expenditures as a tax deduction for 2022. So very high level situation. Maybe you typically incur $1 million in research expenses annually. that would have been fully deductible in the past in the year incurred. In 2022, you are actually looking at only a $100,000 deduction and a $900,000 add back for tax purposes. Very significant. So you're going to see that talked about. I think that's something that in the profession, the thought is there is much support to have this changed, at least delayed, if at all possible, so that this tax spike doesn't hit right now for 2022. But we do need something passed for that to change. And I know you might be thinking, I don't claim the R&D tax credit. This doesn't apply to me, or I'm just not going to claim my R&D tax credit instead. Unfortunately, that's just not how this works. Code Section 174 is a specific provision in the IRS that is 100% completely separate from the R&D credit, which is under Code Section 41. And so we do just have to be mindful and have to start really working through if we don't see something passed here in this lame duck session, where we have to start quantifying these 174 research expenditures. They are a little bit more broad than what the R&D credit Section 41 R&D expenditures are for. And also I would caution the idea that, if you have been claiming R&D credit and reporting R&D expenses, for that benefit for the past several years, it's not going to be advisable to suddenly just stop that and say you have no R&D expenses. It's probably just not very likely. And, so we're going to reach some compromise in regards to how to quantify those true Section 174 expenditures, because there's not a lot of rules and regulations on that right now. It's just not something that's been legislated or brought through the court system, because it's not something that's mattered significantly previously. They were 100% deductible, and so unless you're claiming R&D tax credit, which has much more definition to those Section 41 expenditures, it really wasn't of significance. So that's a really important item. I want to see us looking at that before the end of the year for our taxpayers, and hopefully finding some relief, at least temporarily, if not permanently, from that provision. And then bonus depreciation, just keep in mind where that sits before the end of the year. For 2023, it's set to start to ratchet down to 80% deduction in the first year. So keep in mind any expenditures you have, if you're looking to accelerate that deduction and truly have the full 100% expensing, you want to get your assets in service, not just purchased, in service, ready for use, ready to be able to be utilized in your business before the end of the year, so that you can obtain that 100% bonus depreciation. We may see a patch, we may see that brought back up to 100% for 2023, but current law says it is 100% for 2022, and then on 1/1/2023, it's 80%. And the next chart just kind of shows how that's set to move down over the next stretch of years. And then just a quick slide thrown in here next is to keep top of mind some of those inflation adjusted items that we're going to see for 2023, where the tax brackets fall, where some of the limitations and phase outs hit. So wanted that as a resource for you. That was released recently by the IRS. So keep those top of mind as to where some of those thresholds and limitations are applying for 2023. And I will let Glenn bring things home here with just looking way out as to, again, not something, it's not as far away as we ever thought when the Tax Cuts and Jobs Act was enacted, and where are we going when we get to 2026, and really what is this next Congress when they start in January, going to be dealing with or looking at, sooner than we think.
Yeah, thank you, Jenny. Very, very good stuff there. Yeah, so we're looking way out, as Jenny said, 2026. So a lot of things, Tax Cut and Jobs Act, a lot of things expire basically in 2026, meaning 2025 would be the last year of, quote unquote certainty. Again, I believe it's 23 provisions that would expire. So this slide, the way I'm presenting this slide is, what did the TCJA do? Tax Cut and Jobs Act. So it reduced individual tax rates. So meaning that if that goes away, individual tax rates go up. So just, kind of got to phrase it one way. So this is what it did. So it reduced individual tax rates, and not just the top rate. I mean, yes, it did reduce the top rate from 39.6 to 37, but it also, provided other lower rates, like a new 22% bracket, a 24% bracket, instead of the 25 and the 28. So again, individual rates would go up if nothing happens, right? A big one here is TCJA established, put in place for the first time, the qualified business income deduction, the 20% deduction. So if you make $100,000 and it's the right type of business, you actually only pay tax on $80,000. So really that top rate of 37% is actually, if you do the math, 29.6%. So, again, if this goes away, if we go back to the way the rules were, that's a big change to the ultimate effective tax rate that you're paying as a business owner. So that's a huge one. Other things, it increased the child tax credit, it increased the standing deduction. There was an alternative minimum tax thing that it put into play that made many, very few taxpayers now being subject to alternative minimum tax. So those things would go away. We might remember that it limited the state and local tax deduction to $10,000. So again, all these things are things that would expire in 2026. Here's a big one, the state and gift tax exemptions. Jane just had a slide about how much that the inflation adjustment would be. It's going to increase like $1 million, I believe, very close to $1 million for 2023. Well, what did the TCJA do? It doubled the estate and gift tax exemption. So again, if nothing happens, the estate and gift tax exemptions get basically cut in half. So pretty significant. Another one is the charitable deduction limit. It was always 50%. It went up to 60. It would come back to 50% if nothing happens. So these are all things that, again, are we going to fix these? Are these going to be made permanent in the code or not? So speaking of things, what are things that aren't going to expire in 2026? I think this is a good thing to keep in mind. Number one, for the C corporations out there, C corporation tax rates, as a reminder, they were lowered to 21%. It does not go back to what the rates were in 2026. So it's effectively permanent. Just like those interest expense limitations that Jenny just talked about, it's not like that resets and we go back to the old rules in 26. So just a few things that don't change, but again, a lot of things would change in 2026, which isn't that far away. Okay, questions. I've been trying to monitor the chat. Any questions out there? Please chat them in. I know we're about on our time here, but Jenny, other thoughts from you?
No, that kind of covers it, and what we know today and what we're looking to see happen in the next couple months with both Congress, the IRS, leadership. What we know now. So as you feel free to put questions in. If we can't address them now, we'll certainly reach back out. Just a few housekeeping items. As a reminder, a survey is going to pop up at the end, so complete that to receive your CPE credit. We will follow up with any answers we still haven't answered. The session is being recorded, and we'll be sending out a link to that recording afterwards. And please note, we have recently launched an on-demand hub in our website that does house all of our webinar recordings. You can always go back to any of them. And a link to that is going to be provided in a follow-up email. Like we said, we know what we know right now, but there are still unknowns. So keep that in mind. And if questions come up as things get firmed up, please certainly reach out to us and we can provide you, your business, with support. And, I'd just like to say too, in recognition of Veterans Day tomorrow, certainly want to thank all of our veterans for their sacrifices and for all the service that they have made to our country. Thank you to you and your families for your sacrifices and courage, and we're forever grateful to you. So with that, I don't see any other questions. I thank you all for attending today, and have a wonderful day. If it's warm by you, I hope you get outside and enjoy a little bit more nice weather before we get to winter.
Very much, everybody.
Thank you all.